All right, so my next guest says that even with the deal over the weekend, the market has been bracing for lower corporate earnings. I'm going to bring in now Bahnsen Group, their managing director, David Bahnsen. So just real quick on the deal, just your initial thoughts. It's obviously movement in the right direction.
Absolutely, and it's really good relief for small business that now they can use the next 90 days to fortify inventories, to get products on shore. I think that it's a much more dramatic move over the weekend than markets had been expecting, hence the rally today, Charles.
And we'll have a Christmas. Over the next 90 days, we'll get all those Christmas gifts in. One thing that you talk about a lot, but you had it in your last note that I saw, the PE ratio, particularly the E part of this, it had come down a lot. It's back above 10 and the long-term historic, the 5 and 10-year average.
Yeah.
Why is this so important for you?
Well, look, I think that your entry point matters a lot in terms of expected future returns. But you can even see all these years, the PE of the market was below 18. It's averaged about 16, 17 over 30 years. But it isn't usually there. It's usually above it or below it.
Right.
That's okay. It's just that what you can see is it's not exactly cheap. And this is even in a period where the market had been down 20% from mid-February through early April. It was still holding in at an above average multiple.
And this is somewhat of a confusing chart, folks, but it's sort of saying the same thing, that over the next 10 years, the higher the PE ratio is, the lower the return over the next 10 years. So the markets can get over their skis a little bit here. And that's one thing you always try to have people cautious on. You're also excited about the fact that what we're seeing in the market is moving away from the Mag 7. You think that's healthy?
Well, you can't rely on a couple $3 trillion companies to become $6 trillion companies. It's really tough math if that's what your whole investment strategy is. Look, it's very hard to become a $6 trillion company.
Right.
The fact of the matter is some of the other sectors in the market did not experience the big moves higher in 23, 24. They're more reasonable valuations, and it's just a more diversified approach. So there's other sectors in the market we think offer great opportunity. And, of course, you know what I'm going to say, Charles. You want to get that from dividend growth.
Right. We're going to show that in one second. But the bottom line is that some of these, where we do see green year to date, there's probably still more potential because they've been so far behind, whereas the temptation might be, all right, I'm going to buy technology on weakness.
That's right. I think you have other areas that have lagged, and even today in the rally now, you see financials really moving up. You see industrials. So there's some more pro-cyclical stuff besides technology that is catching a bid.
Yeah, I love that, by the way. I'm overweight industrials.
Yeah.
This is a chart I know you love, right? This is the dividend growers. If you put $100 in the market way back when, if you bought the dividend growers, explain those dividend growers.
See, what I hear all the time is, David, your dividend growth is such a great strategy. It's a little lower risk, and you're going to get a lower return, but it does well. And I say, I'm just telling you, I don't believe you have to sacrifice return for the better result of dividend growth. You're getting income, you're getting growing income, you do get a little less volatility, but as you can clearly see, you haven't had to give up return to get that. The dividend growers, why do they do better? Is it because of getting the dividend? Sure, but it's also that they're better companies.
Right.
The companies themselves that are able to sustain a growing dividend over multiple decades, they themselves have better balance sheets, better management, better business models.
So let's talk about something that you like here. IBM has been a favorite for a lot of folks, not for the dividend side per se. It's the quantum play. They're doing different things. They're trying to catch up. That last earnings report, they got smacked around pretty good. But you like how they're positioned right now.
Yeah, and they're higher than they were now after the earnings report. So they took a little hit back. But remember, they were up 100%, since this Red Hat acquisition, their hybrid cloud business. What's funny is the people should like it for the dividend because the dividend is signifying management's confidence in the strategy. They've grown it every year. Our dividend at where we bought the stock is 10%. So even though the current yield is 3.5 or whatever, it's a 10% dividend from where they first were at. You want me to move to Texas Instruments?
Sure.
Because that's another one too, is everyone's talking about semiconductors, about NVIDIA, Broadcom, the AI play. Texas Instruments is doing a lot more old school semis. You still need semiconductors for stuff besides AI. They had a really tough part of the cycle. The valuation came way lower. You got a great entry point. Now Texas Instruments is really
and people
geared.
Still using calculators.
Yeah,
I'm just joking.
The fact of the matter is they are, but of course automobiles and appliances.
I'm just joking. Brookfield.
What a great story here. You have data centers, so people like the AI and the new school type of stuff, but they're also doing pipelines. They're also in more traditional infrastructure, bridges, tunnels. So it's It's an infrastructure play, BIPC, 5% dividend growing every year. And that infrastructure play, you talk about industrials, there is going to be a lot of activity to get us ready, not just for AI, but other elements of the economy. Brookfield is well positioned to benefit.
I got to tell you, I love your dividend approach. I think everyone should have a portion of their portfolio assigned to this kind of stuff. Bottom line, you will sleep better at night.
Thanks, Charles.
Good stuff, David. Really appreciate it.